we need something that will allow us to thread the needle. We can't allow the US economy at this point to go into a nominal recession. Um, and then we also need to reduce the interest burden, the debt service that the US Treasury has to pay its debt holders. And then also at the same time, we want to grow nominal GDP, as you know, Treasury Secretary Bissett on the Sunday morning talk shows 2, 3 weeks ago, I believe, where basically the announcement was, "Hey, we're going to run it hot. We're going to grow nominal GDP faster than the actual
Than
debt grows,
inflation. Yeah.
and that will over time lower the debt to GDP." Right. So what's actually going on here? Why does the 10-year matter? So the biggest thing, we'll get into the bank balance sheets in a second and how this will work through the system. But the real correlation between the 10-year, right? The 10-year bond, check how much is there outstanding. Um, it's it's not that much of the US Treasury's total funding, right? Like everybody knows, like as we've run up this deficit situation and we crank up the national debt to 37 trillion, the duration of the debt outstanding has moved down, right? To the point where something like about 20 or over 20% of the debt is now front end T-bills, right? So duration on the overall debt is coming down. My point there, banks don't necessarily need to fund a ton of the 30-year, or remember when everybody panicked about the 20-year auction that tailed by over a bit over a month ago at this point. That's not really what matters here, right? Because like very little of the overall debt is on the long end. The 10-year matters for consumer credit creation, and where the rubber meets the road is mortgages, right? 10-year rate sets it's your benchmark rate for the 15 and 30-year mortgages, right? So if you look at it, like I put a slide in with the TBA mortgage pools in a second. It goes through the size, right? So if the 10-year Treasury, the current coupon bond is somewhere between 50 and $100 billion outstanding by the time they hold the 3 monthly auctions. There's one primary and then two reopenings. These mortgage pools, like the Fannie and Freddie, as just one kind of section of the overall residential credit creation industry, which is your biggest hitter, your largest source of private sector household debt creation. Your 15 and 30-year mortgage like rates need to hold up, right, to keep the private economy going, to keep nominal GDP humming along. And so, yeah, as Cameron has right now, I think you have the slide with, yeah, $68 billion in Fannie and Freddie loans outstanding, and that's on the February 2025 issue date. So these will come out quarterly. So we need the credit creation just humming along, flowing through the pipes for this for the U.S. economy, for the system, and then downstream of that would be the federal debt just to keep humming along. My point here, Cameron, if you go back one slide, what I've got here is in white is the 10-year future, and specifically the forward yield to maturity on the cheapest to deliver. This is what the street will price against for its cost of capital on funding a mortgage, right? Because to go out and create all these originations, you have to do just a bunch of hedging transactions. So tapping, say, the futures market would be one of the key sources. But you look at that yield on the 10-year future, that's got to respond to the actual housing starts in the real economy, right? Because your housing starts will front run your mortgages. If you think about this as a pipeline, right? Well, you start, if you're going to build a new unit of real estate, right? What do? Start with a permit, then you get your credit financing taken care of with your bank or some other financial institution. Then you officially start construction. A lot of times you'll market it. You'll do the real estate listing on, call it a pre-build, happens quite often or in a hot real estate market. Um, and then you get into like sales, right? And so the actual consumer mortgage will come during that completion process. It's like manufacturing any other type of good, but this one in particular, just because of the size and the purchase amount relative to the American worker or consumers, balance sheet assets, it's credit financed. So the financing is hugely important to keeping this key sector of the U.S. economy, housing, humming along. Now, housing starts, I got the 6-month moving average in orange, and you can see that it correlates with that yield, right? So what am I getting at here? The dots on the housing start are actually, there's a monthly time series that's reported. It actually just reported this morning, in light of all this other stuff going on. And there was a massive miss on housing starts. Now, 1 month doesn't make a trend, but when you look at the overall trend, of housing starts, I didn't zoom out the full way here, but from basically post 2008, once you get into 2010, 2011, the housing starts bottom after the 2008 crisis, right? It's uptrend all 2010s up until, the steam wears out in 2021, 2022 on all that COVID stimulus that came through and kept the party going. Well, now we're in the hangover. And you can see here, if you look at the moving average, the housing starts, it's trending down now. We're in decline. We're going the other direction, right? And so this miss now, what this tells you, the yellow dot I just posted, this housing starts number that came in for May, missed survey estimates. What it's telling you is the real economy, the gravity, the direction of trend is actually down. So what do you need to do to kickstart the real economy back up, keep your nominal GDP going, keep it possible to grow it faster than the debt outstanding itself? Well, you need to get the 10-year rate to come in, right? So I'd say the key here with the eSLR, you want to fire this weapon. We've had it in store. We were talking about this last summer. I recorded a special episode with Nick Bhatia on the Bitcoin layer that goes over the educational, like the ins and outs of the eSLR and capital requirements post 2008. If you want to go back and watch that, maybe we'll link to it in the show notes. But what do you do here, right? You need the eSLR to increase capacity of treasuries, right? And then when you lower rates, so the reason that housing starts are low is because the American consumer, like there's no demand, like there's a demand shortfall. Why is oil at 75 as well? That's growth, that's demand that are low. So to go and incentivize the American worker, the household to go get that mortgage, you've got to get lower rates, right? So the actual transmission mechanism to make all this engine work, right? You've got to get the American household to go out and finance their mortgages, keep the economy humming along. How do you do that? Put some stability under the 10-year, get that lower, right? And so that's the kind of the policy direction we're seeing kind of take hold. So that's going to come. I mean, it could be any time now, but that's really what you want to see, right? It's supposed to be counter-cyclical. We want to get housing back on track. That alone isn't going to solve that downward trend that's in the time series for housing starts, starting in 2022. But it gets us out of the kind of the trough of the cycle would be what I'd expect. Now, all right. And I think the last thing we'll talk about before we shut it down for the day, we've talked about U.S. commercial banks' balance sheet expansion. Now, all else aside, we talked about stable coins are coming for this business, massive disruptions in place. That's definitely true. But that integration is going to take time, like years, to fully play out. So we'll be talking about that development for, the next 5 to 10 years, I'm sure. So long as Cameron and I keep recording every week, we'll be tracking. But, right now, stablecoins outstanding, right? Tether's about 155 billion, Circle 68 billion. If you add up those in terms of, crypto stablecoins, right, and then market size, bank deposits in the U.S. commercial bank system are like 16 or 17 trillion. So it's a massive amount of room, but before those markets, kind of you see the true disruptive innovation crossover, and unseat the incumbent. That's well into the future. Still, you could call it speculative. But you talk about the short term. How do you get this, current credit system and the federal debt, all of that humming along just to continue into the next stage? Well, I think at this stage, what we've talked about post tariffs, right? What did we say we expected? Balance sheet expansion coming from banks, right? You get nominal GDP running hot by incentivizing credit creation in the domestic U.S. economy. Some of that can come from unregulated banks. There's definitely going to be a heavy portion of that, but a lot of it is going to show up in the call it the legacy or traditional banking system. And so now what we're seeing, we've got enough data on the H.8 weekly reports. They're about almost 2 weeks delayed in terms of the snapshot of where the Fed gets the balance sheet holdings requests. What I've got here is the annualized growth rates on a look back window for the collective commercial bank's balance sheet in the U.S., and then broken down by line item, like loan type, asset class, all of that. And then what you would do is add these together. But the final number, what we're seeing on a look back window, so if you go to like the April 30th column, ever since that initial dip, right, we've seen the total balance sheet of the commercial banking system expanding at a 15% annualized growth rate if we were to extrapolate April 30th to May 28th. Or sorry. It's actually closer than that. I think it's like June 5th would be the latest snapshot, right? And granted, there's some like that may be too hot because of a measurement, because we know after tax day on April 15th, a bunch of deposits leave the commercial banking system and they enter the TGA at the Fed. So these may be overclocking the rate of growth, but a 15% growth rate would be very high for the commercial banking system. And where is that growth showing up, right? 13.9% of it right now is in cash assets, right? So that's additive, 13.9, and then the other 1.1 comes from other stuff. You call it bank credit, right? Bank credit on that line, that section above. The bank credit expansion hasn't even really started yet. And then there's an allowance for loan and lease losses that's taken off 10 bips. That's been recognized so far. So point is, banks are sitting on, the cash is increasing, and you want to get to why. Talked about that. Go back and watch our episode discussing HIBOR and how international money centers, non-U.S. domestic, on their dollar deposits are having to, HIBOR cut to essentially zero, right? And then Fed is holding at 4 with more rate cuts coming, but still direction of flows is pulling deposits into the domestic banking system. If you go to the next slide, Cameron, we are now seeing that trickle into deposit growth. So deposit growth is now heating up, right? 2-3 weeks ago, last time we checked on this, borrowings was the big contributor, like banks going out and raising, say, a bond in the public markets to obtain money, right? Bank money, dollars. That's shifted over now. Those deposit flows are flowing in, and you've seen this number heat up, increasing. So on a 2-week look back, you've got 17.6 annualized contribution to balance sheet growth, slowed down last week to 14.2. But that effect of dollars sucking into the US banking system because of those high rates, that's happening. And they're sitting on cash right now. As you know, if there is clarity, maybe rates come in as well, that we're not entering some sort of liquidity crisis or a hard landing, maybe would be the term everybody would use for it. So long as we escape that, those cash assets that are building up in bank, they have to go somewhere, right? They're going to go into credit creation is my point here.